Well, I don't know about you, but it has been a wild, wild week in the markets, and I have been looking forward to this recap, and I hope you have as well, because we've got the man himself. Riz is here tonight to share his insights on the market. Riz, thanks for coming out.
Pleasure is mine. Thanks for having me on.
It is always a pleasure to have you on tonight. And as I alluded to, you want to talk about wild movements in the S&P 500. This was the week for it. But I gotta give you credit, Riz, for all of our people in Elite. And you had mentioned this on video actually the day before it happened. This 4,300 level on the S&P 500 is so critical. And even though we pushed really hard on Monday, and I mean really hard down below it, it was bought right back up. Multiple attempts at 4,300, and it just can't seem to break.
Pretty wild, like you said. I can't really think of another word, but ultimately, yeah, I did a video on Thursday, what was it, the 27th um, of January, just kind of giving my top six stocks to carry or consider, I should say, positions that I have a lot of conviction in. And if you haven't seen that video or just wondering where that is or where you can find it, you can just find it on the YouTube channel. You will literally be called Top Six Stocks. So in that video, I did a very quick, very brief. Levels, just talking about the levels in the market, and I said, 4,300, if we can hold that and bounce up from it bullishly, we could see the 200-day moving average level next, and perhaps it can run a little bit further. And Friday, the next day after I said that, we had exactly that. We had the market touch a low just at the 4,300. You can see with that wick there, that tail, and then we had that big push up right to that 200-day moving average, which Chris has as the white line. So yeah, I mean, I can't tell the future, as I always say, but yeah, sometimes I can do certain certain things when it comes to being able to deduce where the market might go. And you know what? I'm not perfect, but hey, I am pretty happy with my track record over the years. So with that said, yes, the last 2 weeks has been pretty critical as the market has been pricing in rate hikes. This isn't a surprise or shouldn't be a surprise to anyone. The S&P 500 after Friday's move, Chris, is down what? I think like 8-9% from the highs, roughly. Yeah, 8%, give or take, right? So we just touched into correction territory, which was just 10% drawdown from the highs. But of course, because of that Friday's massive 2.3, 2.4% recovery, we're not in correction territory anymore. So yeah, well, look at that. And guess what? As Chris has on the RSI there, the market was very oversold. The index was very oversold, and it kind of picked itself out of that rut there. Chris, what we'll also bring up is Nasdaq, which you want to just type in Nasdaq, and you'll see NDAQ. Pick that one. Yeah. Okay. Yeah, you can pick this. I mean, it's the same thing. Really doesn't matter. But ultimately, if we do the from the highs, Chris, where's this at? I think this one's 15. Yeah, it's in the chat room. I see IXIC works too. Yeah, look at that. About 17 from there. Maybe a little bit higher, the previous highs for last year. Um, Probably nearing probably 20%, I think, almost, if I'm not mistaken. Yeah, so close, just 19% after Friday's um, rally there. So the Nasdaq being very much more sold off, very much a bigger drawdown than the S&P 500, because obviously, as we know, tech stocks have been butchered. Although the index is down roughly 18% from the highs, it's no secret that many stocks, many tech and growth stocks, even some that we've held, and I'm sure you, the viewer, also probably hold and are exposed to, are probably down, upwards of 30%, some even 40% down from the highs. So yeah, it's very, very plausible that there's many tech stocks that are down upwards of 50-60%. So we've seen many of these get completely wiped, and I can tell you some of them won't come back. Some of them just won't come back, and this is frankly part of the market. We've seen it in 2001, seen it in 2008, and we saw it roughly in 2020 in March. But that was such a fast pickup that, you know what, everything just came back pushing higher. But this one is more of a correction in speculative, smaller, unprofitable companies, and this pullback could be a big death blow. Not saying the company is going to go bankrupt or anything, but many of these companies just won't come back to their all-time highs anytime, if ever. So it's something to keep in mind. All the ones that we continue to hold, the ones we monitor and watch, and the stocks that are part of my, let's say, overall market worldview are all larger companies. Obviously, many of them are growth stocks. Many of them, don't necessarily have a profit, but they're all large companies, that have been around for many years. So none of that smaller to mid cap speculative nonsense for me. So we should be relatively safe, even though we have some drawdowns there in some of our positions. So it's nothing too much to worry about unless you have those kind of crazy uh, speculative stuff in your account. So moving on, I think back to the S&P 500. I think it's very critical to see how this week goes. I'm keeping an eye on Monday. Well, Sunday futures open at 6 p.m. Eastern, but Monday as well, of course, to see how the market opens. And we've seen a lot of intraday volatility, a lot of swings intraday. Um, and I would like to see how Monday goes before I can really dig my heels in and say, okay, I think, you know what, I think this can push upwards. Or maybe there's some talk that, some people, even in elite, are saying maybe this is a little bit of a uh, a bull trap. Essentially a little dip buying going on. And what if it's kind of like a dead cat bounce type of scenario? But that remains to be seen. I think it's a bit early to call it. We can only look at it from a probability standpoint, from key areas and levels. Chris has them marked on his here. But yeah, I think I want to see if we can get to the 4,400 area on Monday. If we see a breakdown from this 200-day moving average, if we see it retrace lower, well, then it adds a little bit of a spanner in the works. It makes our job a little bit more difficult to determine, because a rejection of the 200-day moving average and, let's say, the 4450 area. I said 4,400 earlier. Sorry, I meant 4,500. But the 4,450 area can act as a little bit of a ceiling along with that moving average. So I'm waiting to see. So it's caution is very important. And I know many of us in elite, including myself, have a certain cash position still left. So although we have bought some companies, I've listed and released for elite members my coveted um, dip buy list, and it's an extraordinary company, and you probably list, and you probably noticed that a lot of them are in the buy territory, being the the growth companies, the tech companies, right? And you know what? We will look at a few near the end of the webinar. Before we get into Q&A, I'll highlight a few other trade ideas for this week. And remember, this is another week where we have a lot of big name earnings, and I'll run through that quickly as well. So yeah, that's my kind of summary of markets, where we could head start of the week. Again, it's going to be very important. And I know many of you guys in elite are patient and have been carrying the cash. And I have a personally around, after I close the Visa position for a profit, I have around 32% cash, which I'm looking to utilize now. Honestly, I think regardless of what happens, I'm going to probably average into some of the positions that I already have. So be aware of that if you're an elite. If you're not, well, then, you're not going to know what I'm getting into, or what I already have, and what I'm going to be buying more of. So it really does pay to be an elite. And what I feel like is I need to bring that cash pile down a little bit. Maybe markets go lower, so be it. It's fine. I'm not going to try and exactly time the bottom. Maybe this was the bottom, right? This 4,300 bounce up could be the bottom. And if it is, I can at least sleep easy at night knowing that I pretty much bottom ticked this one, right? I really said, okay, look, 4,300, watch this zone. and poof, touches it and then picks up not once but multiple times. So yeah, I think if we see a little bit of a recovery, I would continue to scale in. Obviously, there's no time like buying when prices are lower, but good luck telling if the future and knowing if that really is as low as it can go. Um, so yes, I will be updating real time as I look at markets and analyze, and any decisions I make, you will be aware of in real time.
Yeah, and I think that's the real important thing to remember, guys, is uh, during these times you're never going to know exactly where the bottom is. Everybody wants to say, "Oh yeah, it's going to be right here. It's going to be right here." It's easy to say after the fact, but when you're in the moment, it's really difficult to tell. And if you are investing and trading solid blue chip companies that are not going anywhere, that actually make something, that provide a service to the industry, then you're going to be in good shape. If you're taking penny stock BS or incredibly speculative companies that are somewhat questionable as far as their fundamentals are concerned, then maybe that might not be the best thing to be putting your money in an environment like this. But if you are taking those solid companies, even if the market goes lower, you're going to be fine. You're just going to have to hold and get through it, and understand that it's always good to have some cash available, because if it does go lower, like Riz was talking about, what he's planning on doing is you can always average in to make your average even better. So let's take a look here at the breakdown of the S&P 500. I've got it for the year to date. Obviously not a whole lot of data here. Energy still leading the way, but let's just pull it back a year to give us a little bit more data to look at and kind of see where we've been. Obviously, Riz mentioned the wrecking of tech, for lack of a better term. You can see here since about December, late December, tech has been absolutely annihilated by the light blue gray line here. Energy still pushing at the top, and I've got a pretty good idea why that is, and we'll talk about it in a second. Lots of things spiking back up over the last couple days with these, the big move on Friday, obviously. But overall for the last year, the S&P 500 is still up. However, year to date, we are down from the beginning of the year, currently down about 7.5% on the market, while energy still is rolling strong. Riz, is there anything that you see on these that you want to talk about?
No, pretty self-explanatory. We not surprising that most of the sectors are below the baseline of 0%, hence negative year-to-date return. Only energy is the one outperforming in a big way. So a little bit of a continuation of last year as well.
Absolutely, and probably the biggest push on that energy move is oil. Oil on an absolute tear since December last year. Currently, looks like we closed on Friday at $86.82 per barrel on crude oil, blowing through our previous high here of last year at 85.41, and looking incredibly bullish right now. Riz, what is your take on oil? Do you think we're going to make it back to $100 a barrel, or do you think we're going to have a
Yes,
bit of...
there is some talk about that.
Yeah.
I mean, it's looking more and more likely. Uh, the base case could very well be $90 to $100. I think that would be bad news. I don't think anyone really would be happy with $100 oil, besides a few energy producers. And I think this is something that I'm keeping a close eye on. I mentioned in our previous webinars that there's a big supply issue. Obviously, I went into the kind of details as to why there wasn't enough investment in the traditional legacy energy area of oil and natural gas, and we've seen that kind of squeeze up massively. So we'll be keeping an eye on this. But currently, I don't have any, in my trading account, I don't have any pure play oil position. I don't have any direct oil exposure via ETFs or anything like that. I've completely just kind of sat out this rally since the end of the year. So for now, I think I'm just okay watching on the sidelines. If there are some firms, Goldman, so on and so forth, calling for $100 oil because of demand being there, supply shortages, because of some um, global occurrences. There's been some refineries that have been shut down. There's been OPEC, which hasn't increased their supply too much and turned the taps on too heavily. We've seen that there's an energy shortage in Europe. and supply is trying to catch up to that. We've known that there's been a lot of wild swings in weather and uh, even in natural disasters, and we've seen heavy snow, heavy winter over the last month so far across the northern part of the U.S. and Canada. So more inclement weather, a more tougher, a more frigid winter, it usually has a bullish impact on energy, traditional legacy energy like oil and natural gas. So that's one of the reasons as well. It's a multi kind of faceted reason why we've seen oil continue to push up and hold the 80, 85 level and perhaps even go higher. So I don't think anyone's going to be happy with that, as I said. But hey, it's something we have to keep an eye on, especially when inflation is concerned.
Awesome. Thank you for that. And just to quickly touch on gold, it's not doing anything really going on here. Nothing really to report on gold. It's just kind of doing its thing. It's trading sideways as of late. Definitely not a hedge against inflation like it used to be. It seems to be, yeah, nothing remarkable to talk about. Let's talk about another alternative income source or monetary source, cryptocurrency. Bitcoin here having a huge rundown since we hit a new high here on the 10th of November. It has been pretty nasty in Bitcoin. Let's see where we're at. I believe we're close to 50%. Yeah, there we go. Of course, Bitcoin being traded right now since it's traded 24/7. But yeah, sitting right about at negative 45% from the highs right now. But making a bit of a recovery here. We pushed down pretty hard on the 24th and rebounded off of there. And definitely a nice little uptrend here. 40,000 should be our next inflection point on crypto, just to keep an eye on if that's your thing. We currently don't hold any positions in crypto. Riz does not. And so, yeah, any comment there, Riz?
Yeah, no, you touched on the key points. Keeping an eye on it. We've seen some uh, talk from Russia, over the last week or two, saying, oh, they want to ban crypto as well, and they want to stop, crypto mining and all that kind of stuff. And really, I mean, it's just more talk, as you've seen. But yeah, the fact that crypto has and continues to hold above that 30,000 level from last summer is very good news. But this is still, by and large, a significant downtrend. We are seeing that a little bit of a uptrend in the short term, like you pointed out, but in the multi-month kind of viewpoint, this is still very much a downtrend. So I'm kind of keeping an eye on it. No positions, as you said. Ideally, I said if I would see it strongly stay around the 30,000 mark, then I would have probably considered getting in. But just that one small touch point near 33 wasn't enough of an indication for me to get in. But hey, so be it. Right now, 38,000 nearly. And like you said, 40,000 could be on the cards.
I think it's hilarious that Russia is now talking about banning crypto. I mean, how many times has China banned crypto? So this just tells me that Putin is loaded up on Bitcoin and he needs to affect the price. So he's going to say that Russia is going to ban the use of it. I think it's comical. I hope all of you can understand my sarcasm there. Of course, I don't know the holdings of the current Russian quote-unquote president. So let's move away from crypto and talk about some securities. Riz, you had alluded that you had some securities you wanted to share with us, stuff that you're watching this week.
Yeah, so this week is another continuation of earnings season, a big one, and some companies that I'm going to be watching closely are AMD. I mentioned it in another video as well. So this one's really, really oversold, as you can see with the RSI, down from the highs, I think around probably good 30% or so. 35, nearly 36%. So yeah, if you like AMD at the 150 mark, well, you should love it at 105. And you know what? I really like it at this point. It's another growth stock, obviously in the semiconductors, similar space to Nvidia and Intel. So yeah, this one's having earnings after close on Tuesday, so something to keep an eye on. I don't have a position yet. PayPal is another one. I do have a position in this, and this one reports same thing Tuesday after close. And this one's very, very oversold. Had a little bit of a pickup on Friday, but still in a bullish downtrend from the highs, probably down around 50%, 48% almost. So yeah, keeping an eye on this one as well. And Alphabet, aka Google, GOOG, and yes, this one is phenomenal company. Obviously, one of the best large cap blue chip type technology companies you can consider. And this one has a nice rally from about 2500, so right off that 2500 hold down mark. So this is looking good as well. Tuesday after hours, so keeping an eye on this. And Starbucks. Starbucks is also Tuesday after hours, so it's going to be a busy Tuesday after market close. And this one's just consolidating here as well. We also have Facebook, which is obviously now known as Meta, on Wednesday after market close. So this is something that I'm keeping an eye on. I don't have a position yet. I kind of not too favorable on Facebook personally. But from a technical standpoint, it's right near that long-term support that Chris has highlighted near the 300 area. And so this will be interesting to see. And we also have Qualcomm, QCOM, and right there, kind of a little bit dip, but still holding those gains from end of last year. And Spotify is as well after close on Wednesday, and this one's beaten down a bit. So let's see where that goes. And lastly, I am of course interested in Amazon Thursday after close. I have a position in this, extremely oversold, um, phenomenal, obviously juggernaut of a company. So this will be interesting how they do, because they are going to be reporting their holiday uh, sales, right? So that's always a big one for retail type of companies. So these are my kind of views on the stocks that are coming up with earnings. Obviously, there's a lot more companies releasing earnings, but these are my kind of few big ones that I'm keeping an eye on. Some that I have a position in, and some that I don't.
That's great. That's definitely some great information for those that are looking to maybe capitalize on some opportunities. Of course, understand we're not giving you financial advice or telling you what you should take, but just some stocks that we're keeping an eye on currently. I want to go ahead and open it up to questions, and Evgeny has been waiting patiently. He posted this question earlier. It's about the S&P 500. He said, would you buy aggressively as we start to recover? Say we quickly get to 4,500 and then, blast up to 4,600. If so, how much of that cash pile that you talk about having around would you plan to use in this case?
If we see a run up this week, let's say rounding it, simple number, I have 30% cash, and I would try and bring that down to 15% if we continue to rally. I really want to make sure I can utilize capital. I don't see myself, if we continue to get a really big push from Monday onwards, I don't see myself being able to allocate all 30% very quickly, because of course my nominal values are different to other people's. So you know what, it's fine, because I did average in some already. I did take some positions on these dips. So even if I am not able to put all my capital to use on a recovery, that's okay, as long as I can sit back and say to myself, yeah, I did a decent enough job allocating capital, and I didn't just sit like 50, 60, 70% cash, and then now the market's rallied back up and I'm sitting there with nothing in hand. That would be a colossal failure if someone did that. So it would be a shame. So, which is why I've been saying, should have been averaging in, should have been considering solid companies, and which we have in Elite. And really comes down to what happens this week. The fact that we've been able to hold the 4,300 level, which I've said many times, like a broken tape recorder, that is a very, very strong support level, pretty much a very crucial battleground level between buyers and sellers. And that continues to hold up. Um, Again, if we do go below, then of course the whole thesis goes out of the water, right? We got to reevaluate. But right now, I think it's holding up nicely. I will be looking to implement capital regardless. I think I'll be looking to put money in into existing positions and perhaps new ones, regardless of what happens in the market uh, the next few days.
Yeah, that's the thing, guys. It's like, yeah, we could see a move either direction. 4,300 is solid, but it's not, some magic number that's like, no, the market cannot go below this point. But we have a plan no matter what direction the market goes. And Yas is interested in this question. He says, from your experience, how does the market behave during interest rate hikes like we're experiencing now?
Yeah. So historically, based on data, we could say that during periods of rate hikes, markets, you would think, oh my God, this market's going to be crashing or like, negative. And that's not always the case. More often than not, markets are positive. Of course, varying degrees of performance, could be up 10%, could be up 5%, could be up 15%. But generally speaking, during periods of rate hikes, markets do tend to still do decent. Um, Obviously not as good or as rip your face off type of runs that we have in very loose monetary policy, but nonetheless, more often positive than not. There are, of course, a couple years here and there during rate hikes where markets are a little bit under, like, let's say, negative or aren't positive returns on the year. So, yeah, I think we'll have to wait and see how this goes. We know that there's theoretically, potentially, the market is factoring in 4 rate hikes for this year. The first one we could see as early as March, which is when the Fed meets next. There is no Fed meeting in February. So I am anticipating the first hike to be then. And I think the market is also kind of anticipating that. What has thrown a little bit of a curveball now, from uh, the Fed chair meeting last week, this past week, is the signal that perhaps, now keyword perhaps, there could be one potentially rate hike this year of 50 basis points. So when I say rate hike, I'm generally, more often than not, based on past occurrences, the Federal Reserve has raised rates by 25 basis points, aka 0.25% per increase. If they do a 50 basis point rate hike, aka 0.50%, well, obviously that wouldn't be unprecedented, but that would be more than anticipated. And I think that's really the um, kind of X factor that we're looking at here. Not that the rates are going up, but how much are we looking at for the year? I was of the mind that perhaps we see 4 rate hikes, 25 basis points each. But what if we see 4 rate hikes with one of them being 0.50% and the rest being, 0.25%? So what if we see potentially, 1.25% increase in benchmark rates for the 2022 year? It remains to be seen if they end up having the guts to do that. So I am expecting potentially around a 1% increase from benchmark rates, but who knows? I could be off by a little bit. Maybe the Fed, based on what they see in terms of inflation, what they see in terms of economic data, they find that, you know what, we don't want to overstep. So maybe we'll do 3 rate hikes of 0.25%, 25 basis points each. So at that point, that could be a good 75%, 75 basis points for the year. So look at it this way: the range being 75 basis points to 1.25, okay, percent. So just roughly keep those in mind.
I see a couple other members typing, but I'll go ahead and throw out a question here. It says, what's the concept really behind increasing, the interest rates? Are they trying to, rein in inflation, or is there something else going on here that, dictates that we need interest rates, to go up?
Absolutely. So, yes, they are trying to rein in inflation, but also rates have been low as a reaction to the pandemic. If you recall, 2018, 2019, 2017 or 2019, rates were inching up slowly, and it was kind of trying to normalize after, um, you know, big loose monetary policy and rate cuts of 2008, 2009. So we were making our way up, but of course, as we know, 2020, the world got turned upside down, and almost all governments just completely slashed rates altogether, undoing all the progress that was made. And inflation is a result of not only very, very low, aka next to zero rates, interest rates, but also the stimulus and government spending and the Federal Reserve buying bonds, and essentially increasing their balance sheet. So there's multiple factors at play without getting too complex, but ultimately they're raising rates to control inflation, because if they don't raise rates now and inflation goes out of control, they'll be behind the curve, which I think they already are, but they'll be even further behind the curve, and they won't have any tools to counter it. So we know that can be dangerous, right? Uh, and that's why I've been saying, for the Federal Reserve, who unfortunately didn't listen. Obviously, it's unfortunate they don't have a direct line to me, but you know what? At least they're doing it now. At least they realize, whoa, inflation is not transitory. Oh, we screwed up, and maybe it is here to stay unless we do something. And here we are in 2022, where they're trying to do something. Let's just hope it's not too little, too late. Um, I frankly, I felt they should raise rates in their last meeting in January of 3 days ago. But hey, they didn't. So here we are. But yes, you're right. Is to control inflation and also to cool down the economy a little bit. Because if you have a runaway economy that's too hot, too frothy, like we've seen, where it's impacting pricing of pretty much anything and everything, you name it, cars, housing, luxury items, groceries, you know, anything and everything. Well, what does that happen? It essentially prices out and negatively impacts the average citizen, the average consumer. So we don't want a runaway inflation. You don't want an economy that's too frothy and too hyped up. So you need to have that balance, right? You want the pendulum to swing, but you don't want it to swing at two extremes between bubble and bust. That's where the Fed comes in. That's what the Fed was originally created for, and that's one of their mandates, to make sure the economy is chugging along reasonably. And of course, I feel like they're a bit too focused on making sure the blunting the impacts of some of the negatives, because anything that happens, it just drop rates, which I think is not the way to go, especially after having low rates for so long, right? And it's become normalized to have low rates, where I don't think that's reasonable. It's not a way we should be conducting monetary policy. But hey, who's listening, right?
Yeah, it's unfortunate they haven't installed the little red phone with your direct line to the Fed yet. It's unfortunate that they haven't done that. We need to talk with them about that. All right.
Yeah, we gotta get on that.
Absolutely. All right. That's for our next board meeting that we'll have. Yas has a question again. He says, since your focus right now is mostly on the tech sector, with rate hikes going up for the next few years, what other sector or sectors would you have in your portfolio during times like these?
Yeah, so we've already seen that kind of in play already with value, the value factor kind of playing in with what is value companies that are defensive companies like Walmart and things of the nature where they're consumer staples and consumer oriented, and they're cash flowing, you know, behemoths, companies that have massive amounts of free cash flow. They have a solid base, solid structure, and all they got to do is continue to operate in a good way, and ride out a more volatile economy and volatile market. So really anything that's a consumer stable, anything that's defensive and has a good business, has solid financials, I think you'll be more than fine uh, to weather any storm.
Awesome. All right. Tom has a whopper of a question here, so let's dig into this. All right. How much clout should we be putting in the metaverse? Do you see this being something that actually affects the market if companies are using or advertising money, things like that? I know there will always be things where companies or people can benefit and make money off of, such as crypto and NFTs. But at what point do you ever look at expanding into these environments? Crypto will probably be around, but most cryptos will experience a bubble. We'll see. Tom thinks NFTs are also going to go, but with the metaverse, who knows? So, what's your take on the metaverse, Riz?
Yeah, the metaverse is a fun little um, backyard topic. Really, it's way too early is way too in its infancy, and I know that that can change very quickly. But right now, it's far too early. There's obviously some companies with ties to metaverse and the area of metaverse and digital assets and digital world and blah blah blah. But really, I feel right now it's just kind of like a catchphrase. It's kind of like a very speculative, very out there kind of thing, and I don't see any validity to it yet. So that can change, as I said before. But in terms of crypto, NFT, metaverse, we it's kind of um, funny, at least in my views, that they're all kind of connected now, right? It's like metaverse piggybacks off of NFTs and digital assets, and then NFTs obviously have very much to do with the blockchain and crypto, and then crypto and NFTs are obviously a part of the metaverse structure where you own a digital yacht that you can't even use right now, or you own, a Picasso or a Monet or Mona Lisa or anything that's digital version, and you saw pixels as opposed to anything actually. So I just don't get it. It just makes no fucking sense to me. And anytime anything makes no fucking sense to me, one of two things happen. I mean, well, not trying to be full of myself, but mostly I end up being right. But the few times that I'm not right, what happens is, uh, maybe it becomes widely adopted, but most importantly, it becomes more fleshed out. Meaning now there's a roadmap. Maybe now there's something. Right now, what's the metaverse? You have the Oculus, right? Or you have another VR headset, and maybe a couple of companies that have a certain area, a certain playground that you can go into and just kind of do wonky things. That's it. That's really it. There's no integration of NFTs yet. There's no integration of any of that. And it's all kind of up in the air. It's fairy dust. It's like maybe someday. It's like this utopia that people couldn't create in the real world. So they're trying to create it in a magical forever ever land. Me, I personally rather live in the real world. I'm a gamer. There's no denying that. It's something that I've been very open about. I'm a gamer, a hardcore gamer since pretty much I was born, um, and I continue to be a gamer now. But even then, I cannot personally, um, be too excited about the metaverse in its current form. Okay. So it's something I'm going to be keeping an eye on. Obviously, this is a developing thing, and Facebook's continuing to, or Meta, I should say, is continuing to put a lot of money and investments into this area. So we'll see how it goes and how the implementation comes. But right now, it's far too early to tell. I'm not really interested in buying a pretend fucking yacht or supercar that I won't get to drive or sail or do anything in or sit in or experience. I don't really care for digital art, like stupid looking monkeys with ooze coming out of their eyes and all kinds of nonsense. So I just rather use my money to light a fire with, to be honest, or give it to someone else than do that. So yeah, I'm probably sure people are going to be, there's people out there that are not going to agree with me or maybe get triggered or pissed off, but that's just my honest view. It doesn't mean you have to agree with me or that I'm 100% right. It's just my opinion.
Gosh, you gotta love the monkeys with ooze coming out of their eyes. I mean, I just don't get it. But trust me, buddy, I swear to you, if you tell me you're gonna go buy a digital yacht on the metaverse, I will stop you, and you can just, send that my way instead of lighting it on fire like that. So yeah, I have to say, we're not ready for Ready Player One. Let's just put it that way. So. I have to agree with you on that one, Riz. I think it's way too early to know whether this is going to be anything at all.
Yep.
All right, so Claire has a question for us. She says, why are rate hikes worse for tech companies than other companies? Is that because when people have extra cash, just laying around in between the sofa cushions, they're more risky with growth stocks, and tech stocks are usually considered growth stocks? Similarly, I have read that banks do better when interest rates are high. Yeah, because they're getting more money on your payments. Why is that if people would seemingly have to take out less money because they're paying higher interest? I would think it would be net neutral, if that makes sense.
Yeah. So a two-pronged question. Third question. So first part, why are rate hikes worse? or bearish for tech companies than other companies, because growth stocks, tech stocks, growth stocks, I use that term kind of interchangeably, although they are different. But most of these growth companies, they don't necessarily make a profit. So the companies that don't make a profit, that are dependent on debt, they're dependent on borrowing to fuel their growth and continue this increasing year over year growth, and they're using money that they don't necessarily have because they keep reinvesting in the business. When rates go up, what happens? Their costs go up. The cost to drive $1 of growth for every $1 borrowed is higher now. So what the market has done is discounted the kind of very lofty and very frothy valuations, right? Because now these growth companies will have a lot more cost involved in growing. Hence, it will be harder to grow. And depending on what kind of company they are, what kind of offering they provide, and what sector and area they're in, they could find it harder to keep that revenue growth coming in an economy, in an environment where the consumer has less access to capital, meaning they can't borrow as easily at such a low rate anymore. Now, instead of paying nearly 1% for, or 1.5% or 2% for uh, a fixed loan or something, now it's maybe double that, right? As an example, I'm not saying that's a real world number, but as an example. So people are going to have less capital to use, thus purchasing of these kind of things, like think Peloton, classic example of a growth company, not necessarily a tech company. Growth company makes no money. It's just a I know there's people that really enjoy the product or whatever, but apart from the product and its offering, ultimately it's a growth company. They don't make any profit. They're driving sales and growth and marketing by borrowing money. And guess what? The company, obviously, the sales have completely gotten shattered. Maybe it was a fad, who knows? But the fact of the matter is that it's a growth company whose costs are going to go up as rates go up. And that's further compounded if the company isn't that viable, if the product isn't as viable, if the stock and management, I should say, is not that good. So it's a multifaceted thing, and I hope that kind of helps a little bit. But to your second part, in terms of banks and interest rates going higher, why would people have to take out less money? Well, ultimately, what happens and why we say generally banks make more money is because interest rates go up, they make more money on the capital that's there. So, if you have $1,000, in your checking account or savings account, and right now the bank doesn't pay out any interest, but if the rates go higher, they will pay out a little bit more interest to you, and then you're probably thinking, well, how does that make any sense? Why would their profits be higher? Because they can also lend it out. The money that you're not using, they can lend it out at a higher rate. They have economies of scale. You have $1,000 in an account, as an example. They have millions and millions and billions of dollars in cash across all the customers that have cash in the account, and they can use that to lend between banks and other institutions and generate a return on, right? So that's where we can say that, generally speaking, if rates go up, the banks make more money in interest income. Okay, so that's theoretically why. The risk there is that if interest rates go up, especially after this kind of situation of massive amount of borrowing, very low rates, next to no rates, interest rates, um, a very, very hot economy, very high inflation rate, the risk to banks are, what if people got a bit too carried away, they borrowed too much, or they leveraged themselves too much, or bought things they couldn't afford? Is that interest rate hike going to impact their current debts and affordability? Is that interest rate hike on things that aren't fixed, like a floating line of credit or a personal loan that's not secured, or it's a floating rate, or a private loan or a third party loan that's not fixed, and the rate goes up? That's going to impact their payments. That's going to impact their day to day costs for servicing that loan. Is that going to cause an increase in defaults, or is that going to cause an increase in people not able to pay the bank back? That's kind of the risk as well. So it's not as simple as interest rates go up, banks make more. In one way, sure, but not that simple.
Thank you for that insight. That's very deep. All right, Yas has a question. He wants to take a look at a couple of tickers. It says, "Can we take a look at BA and Home HD, Home Depot, BA's bank or Boeing, excuse me." So Boeing is trending in a downward. Yeah, Boeing is getting hammered here pretty good. Sitting right here on support at this point. Thinks it's looking a little bullish. I'm not quite sure if I'm ready to call that one. Boeing been hammered pretty bad here as of late, especially if we go back to the 737 Max. Yeah, Boeing not looking so hot. Riz, what do you see here?
Yeah, I mean, apart from the bullish flag setup or not, I just bearish or bullish, whichever. I don't really find this to be too intriguing yet. I mean, yeah, it's a kind of like a near-term support of around 190, but I feel like if I'm gonna put, you know, my money into something, or rather put it into something that doesn't really look like this in terms of a consolidation type of chart, like massive long-term kind of consolidation, not much of a movement. It's not like, the company's the greatest either. Like, yeah, they're not gonna go under, they're not going anywhere, but I rather use um, I rather use my money for something else personally because there's other opportunities there.
All right, and then Home Depot here has bounced off the 200 pretty strong. Not gonna lie, came down here and touched on the 24th, and very strong rebound here. Doesn't look terrible in my mind. I think it looks fairly decent. Riz, what do you see?
Yeah, this one is looking nice. Has had a colossal run over the last couple years, but I feel like it's a bit too frothy in terms of valuation, but still a solid company. The fact that technicals also support this big bounce up from the 345 200-day moving average zone bodes well. If you want some exposure to something that is not tech, then absolutely this could be a good technical trade, all things considered.
Yeah, the technical's definitely looking pretty solid. Let's take a look here. Matthew has a couple he wants to take a look at, and Hugo, I didn't miss your question. We'll get to it here. I think we may end with that one. I said he wanted us to take a look at PENN National. This looks like crap. I wouldn't take this. That's just me personally, but man, what a beating.
Yeah, man. We have something another gambling stock, DKNG, similarly crushed. So really, in terms of what I think of them personally, the setup isn't too great. Yeah, I mean, this could be the floor. Maybe they're too battered now. Maybe they're time to come back up. I would keep in mind that earnings are also on the horizon for Penn. I think when is it, Chris? I think this coming month, February 4th. Yeah, next week, 3rd. Sorry. So yeah, be mindful of that. Earnings are a toss up, right? Personally, not something I have too much interest in getting in now. But definitely, if you feel like if the technicals and the fundamentals and kind of what the company does, which is uh, gambling and betting, if it's kind of down in your wheelhouse, then absolutely, I would keep an eye on this.
All right, and then the last one was Sony. Yeah, Sony getting a little bit knocked down here over the last couple weeks, kind of like the market itself. A bit of a rebound on Friday, again, similarly following the market. Looks like earnings are coming up here on the 3rd. I know this
Yeah.
isn't one that we've traded too often.
Yeah, Sony's been butchered, especially because of Microsoft's acquisition of Activision for nearly 69 billion, right? So obviously that's a big kind of blow if Activision's titles potentially do become Microsoft exclusive. That's a big, big hit, even after Microsoft acquired ZeniMax Bethesda last year. So that's one of the reasons why Sony got brutalized. But I feel, yeah, it's not something I want to touch right now. Um, there's some news. Maybe Sony makes an acquisition of their own, and we know that usually when these acquisitions happen, um, they're kind of bearish for the buying company. Uh, so you know what? It's a bit too uncertain, especially with this earnings coming up. I'm just kind of okay sitting it out in these companies. If I have to use my dollars to purchase something, I feel there are better opportunities in my view. Does that mean Sony is a bad company per se? No. I just feel like they're in a very tight spot now with what's Microsoft's able to use the money. Think about it this way. I think Sony's market cap is, Chris, what, like 130 billion, 140 billion, and yeah, 131 billion. Whereas Microsoft literally just bought a 70, nearly $70 billion company with cash. Think about that for a second. They just bought a company worth half of Sony's in cash. That's trouble for Sony, because Sony doesn't have that kind of cash. Sony doesn't have that kind of market cap. Sony isn't Microsoft, right? So yeah, it's something I feel isn't too great for Sony, and there's some headwinds there.
Definitely. All right. Tom wants to know if we're watching Apple this week. Who isn't?
Yeah, of course, we're always watching Apple. I think, especially after the earnings, fantastic earnings. I think it's very much glued to the market as well, or the market is glued to it. Because if Apple, one of the reasons markets obviously had a good Friday was Apple had a fantastic earnings, right, on this January 27th. So it wasn't coincidental that Apple rallied on a Friday, and so did markets, because Apple is the largest constituent of the S&P 500 index. So yeah, I did a little meme on my page, Instagram page, of Apple kind of holding up the market, being the last bastion of hope, and you know what, that kind of rang through, right? So it's something to keep an eye on. I absolutely think, it's a great company. It was a great buy at 160, and I think it's still a decent purchase at 170. Although if you know how my trading style is, you know that I don't like to chase breakouts or big rallies after the fact.
That's just a good trading strategy in general, guys. People who get chased typically get wrecked. Sometimes it works out, and sometimes, yeah, it doesn't work out so well. As they say, some days you get the bear, and some days the bear gets you. Not alluding to markets, but an actual physical bear. And so when you chase, guys, you really open up your risk quite a bit. I mean, with this huge move in Apple here, especially on Friday, it's a bit of a chase. Now, Apple, pretty solid company, not going anywhere. You could definitely hold it for a while if you had to, but could that capital be utilized somewhere else in a better, more effective trade where you're not chasing and you do get to, get a better entry on something else? And so, kudos to Apple. For anybody who holds it, you should be doing pretty well after earnings. We're coming up right here on an hour, so I want to thank everybody for coming out, and especially Riz. Thank you for spending some time with us here, talking about markets for this last hour. It's been a pleasure, as always, having you here on the program.
Yeah, right on. It's great being on. Again, there's a lot of content on the YouTube channel, so if you're watching this after the fact, or you're watching this live with us, check out the YouTube channel, subscribe, give it a comment or like on the videos. And there's, especially the more recent ones, you can get a little bit more detailed insight as to my market breakdowns on the key levels, and of course my top 6 stocks as well.
And with that, everybody, thank you for coming out. Have a great rest of the weekend. Rest up. And for all of our elite members, we will see you in Discord on Monday.